I guess we'll kick it off right now. So thanks to everyone who is joining. Before I jump into it, just a couple programming notes. So unfortunately, Howard had a conflict, so you are stuck with me for the entirety of this presentation. Also, please feel free to submit questions directly in the Zoom portal, or you can email me at cward@gabelli.com, and I'll do my best to address those at the end. And we are recording this for our podcast channel as well, which explains the microphone in front of me. So the goal today is to try to stitch together some macroeconomic themes like economic growth, and inflation, and productivity, and tie that together to business trends that we are observing from the companies that we follow. And then at the end, we'll close the presentation similar to years past with a stock idea we like for 2022. So with that, we'll jump right into it, starting with the economy. So from a high level, economic growth is slowing from an elevated level of about 6% GDP growth this year to about 4% next year, which is a deceleration, but still the fastest growth since 2000. So overall, still very healthy growth. We did see a bit of a deceleration in Q3. That was largely a function of the Delta variant and supply chain bottlenecks, but that slowdown is now giving way to a bit of a bounce in Q4. COVID cases have been improving. At the same time, supply chain bottlenecks are starting to improve. The unemployment rate is down to 4.8% today, but expectations are for unemployment to end next year below 4%. And notably, as we've seen unemployment benefits expire, we've seen initial unemployment claims fall, and that has started to translate into job growth. Earnings will finish this year up about 20%, and 8% growth is expected next year. So again, that's a deceleration, but still historically pretty strong. And importantly, corporate profits drive job growth and CapEx. Job growth should ease some of the wage pressure that we are seeing, and CapEx should drive productivity growth. Both of those serve as offsets to the inflationary backdrop that we have today. And remember, the economy can absorb higher wages as long as productivity growth serves as an offset and maintains low unit labor costs, which would be defined as the output per hour worked. And productivity will come up again later in our presentation. CPI today about 5.4%, so that's obviously elevated, but expected to be cut in half in 12 months from now. And when you think about the mix of CPI, we expect consumer spending on services industries to remain strong, things like travel and hospitality. But we've seen consumer spending on goods, things like computers and furniture, is starting to decline as consumers pulled forward a lot of those purchases due to COVID. So even if services industries do see some inflation, we should see goods prices start to fall as supply chain bottlenecks ease and bring more supply to the market. Lastly, PMIs are poised to trend lower, but from very elevated levels and still in expansionary territory. And we'll touch on that in a minute as well. So in our view, a number of risks have receded in just the last few weeks, couple months. COVID cases have improved, as we mentioned. The worst case fears for higher tax rates, both in corporations and individuals, the worst case scenario there has subsided. And inflation has probably peaked. And there are early indications that we are past peak port congestion. There are early signs that labor markets are normalizing. And again, even if we see continued inflation in areas like housing and rent and transportation, there should be adequate offsets by disinflation in areas like commodities and new and used vehicles. On a month-over-month basis, both CPI and PCE peaked just a few months ago. Now, that being said, there are some new risks surfacing that we'll have to consider for the year ahead. COVID, for example, remains a risk. We've seen a tick up in case counts in both China and the Eurozone. In the US, we've seen a pretty steady decline in recent weeks, but that decline has somewhat plateaued. So we are watching that carefully. And then another risk is a slowing economy and declining PMIs. And meanwhile, there is potential for a Fed policy error. The Fed is in somewhat uncharted territory, given their new flexible mandate targeting an average inflation rate over a period of time, which has really made the Fed a little less transparent to the markets than it used to be. So, what exactly is the definition of transitory? Exactly what level of inflation is unacceptable? And these questions are not as easy to answer as they once were. with tools like the Phillips curve. So this consumer is generally speaking in really strong shape going into 2022. $142 trillion is a record level for household net worth. That's up from 131 trillion at the start of the year. And more than half of that growth is stock market driven. So very strong wealth effect. And combined with an elevated savings rate, the consumer is in good shape. Meanwhile, there is still an above average amount of dry powder on the sidelines in money market funds. You can see about $1 trillion more than pre-COVID levels. So there is potential for cash to be deployed into equity markets. And here we use this for illustrative purposes only, but S&P earnings expected to grow about 8% plus next year. If the market can roll forward its 20 times PE multiple, that would drive an 8% return on the S&P, plus a dividend yield gives you about 10% total return for the market, which is pretty in line with long-term averages. So just for perspective, the 10-year Treasury has made an almost full round trip. So from 1.9% prior to the pandemic to a historic low of 50 basis points last August, in August 2020 rather. And then it touched 1.7% in the spring, and today it sits at about 1.4%. It says 1.6 here when we put the slide together. But the Fed funds rate is yet to move off the bottom, but the market thinks that is about to change. So this is from Bloomberg. And what this shows is that the market right now is pricing in 2 hikes by the end of 2022. And not shown here, but the market is pricing in another 4 hikes in 2023. And rate hike expectations continue to creep earlier and earlier into 2022. The market seems to think that inflation is going to force the Fed to abandon its new flexible mandate. And as those short-term rates tick up, we've seen the yield curve flatten pretty dramatically. So one interpretation of this is that the market is signaling that raising rates sooner than later will obviate the need for more rate hikes down the road. And here's the Fed's own inflation forecast for core PCE, which they have settling down towards 2% by the end of next year. Now, when we look at this, it does feel like the Fed's forecast for core PCE is just a bit at odds with market expectations for 6 hikes over the next 2 years. If inflation does in fact start trending towards 2% next year, it's kind of hard to imagine in that scenario, especially given Powell's recent tone that the Fed is going to be hiking aggressively 7 months from now, especially if we haven't yet reached full employment. And we understand that the Fed has an innate desire to normalize rates, so we could be wrong, but there's just one potential disconnect that bears watching here. So if the market is wrong and we don't get a rate hike cycle starting in the summer, we would expect 2-year yields to fall and the yield curve could potentially steepen. So now here we're showing how S&P earnings are historically very highly correlated with PMIs, which we use as a proxy for the business cycle. And here specifically, we're looking at the ISM manufacturing index. And here we are showing how historically interest rates lead PMIs by about 18 to 24 months. In other words, declining rates like we saw in early 2020 as a reaction to COVID essentially sowed the seeds for the subsequent recovery because lower rates act as economic stimulus. It's almost a self-correcting mechanism of sorts. And the reverse is true for higher rates. So the higher rates we've seen since the August 2020 bottom act as a tightening mechanism for the economy, again, with a lag of about 2 years. As a result, we would expect PMIs to decline in 2022, not necessarily breach the all-important 50 level and go into contraction territory. It's a little too soon to tell on that, but it is reasonable to assume PMIs will decline. And that is consistent with consensus expectations for GDP growth to slow. Now, historically, declining PMIs are it's a very supportive backdrop for growth stocks. Of course, we'd point out declining PMIs are also generally associated with a decline in interest rates. So one thing we are monitoring internally is the potential for the unusual, but not entirely unprecedented scenario where the economy slows, but inflation persists, forcing the Fed to raise rates even as the economy slows. So we don't think that's necessarily the base case, but it's something to be aware of. And lastly, I thought this was powerful enough to be included here, but even Microsoft CEO Satya Nadella chimed in on inflation on Microsoft's most recent earnings call. And you can see he said digital technology is a deflationary force. Businesses, small and large, can improve productivity and affordability of their products by building tech intensity. So Nadella is arguing that tech investment has enormous productivity benefits. Growing technology intensity won't just benefit technology vendors, but will benefit society at large as it pertains to fighting inflation. And regardless of your view on inflation and interest rates, I think you really need to appreciate that COVID launched us into a new world. It accelerated many of the secular growth trends that had been in place for years, and technology is going to continue to infiltrate our lives more than ever before. So I'm going to use that as a segue to talk through some stock specifics in industry themes. We want to revisit what we did last year. So you can see the stocks we presented here on each of our last 3 year-end webinars: Cloudflare, ServiceNow, and PayPal over the last 3 years, respectively. And you can see that each has generated very strong IRRs relative to their indices. This was updated last night, so this does not include PayPal's decline today. And you can see Cloudflare here, which we pitched a year ago on this call, has almost tripled since last December, and it's been one of the top contributors to portfolio performance. So similar to years past, I'm going to use this as a launching point to discuss some of the key business trends we are seeing, and then we'll touch on a new idea for 2022. So starting with PayPal, who just reported last night. So PayPal was a beneficiary from the elevated e-commerce environment in 2020. More recently, PayPal stock has come under some pressure due to decelerating e-commerce growth on a tough comp. There's also some transitory eBay headwinds as eBay transitions to managed payments. And I think all of this was exacerbated by the recent news about PayPal exploring the acquisition of Pinterest, which the stock did not react kindly to. I think investors struggled to appreciate the synergies and were fearful of the execution risks. Ultimately, PayPal did walk away, but I think it's interesting to consider PayPal's motivation here, which is to move further up the funnel from conversion to discovery. And this was the rationale for acquiring Honey. So PayPal is clearly motivated to move up the funnel and potentially participate in the increasingly strategic industry of social commerce. Meanwhile, the core PayPal business, all KPIs remain very strong in our view. Strong active account growth in merchant acceptance. PayPal recently rolled out an app refresh, and we think they're very well positioned to evolve from a checkout button to more of a daily utility digital wallet super app with a full suite of financial services. In fact, on last night's earnings call, CEO Dan Schulman said that average revenue per account from digital wallet users is twice that of a checkout only user. PayPal is going to be rolling out more features in 2022, including investing capabilities, and PayPal just announced a new Pay with Venmo partnership with Amazon, which is a big milestone for the company, as they're now able to partner with marketplaces they were previously forbidden from with their legacy eBay contract. And at their most recent Investor Day, they set out some pretty ambitious targets to nearly double their active account base to 750 million by 2025, and to grow total payment volume even faster at a 25% CAGR. So look, there are certain businesses we own that even when we can see transitory headwinds on the horizon, these are just businesses we own for the long term. We're not going to trade around temporal issues. So we are willing to look past the near-term e-commerce deceleration, the transitory eBay headwind, and we think early KPIs for the app refresh are very exciting, and we expect revenue growth will accelerate through next year. So moving to ServiceNow, the company really continues to execute at a very high level. The company held an analyst day this past spring in which they highlighted a new organic revenue target of 15 billion by 2026. That's up from a 5 billion run rate today. And these are organic numbers, which makes it all the more impressive. Net new average contract value has accelerated for 3 quarters in a row, and we think this is going to translate into very strong revenue growth in 2022. And really, this same story here that it has been for a while. This is an asset with a very unique combination of sustainable revenue growth at scale, growing the revenue growth about 30% at a $5 billion revenue run rate, and best-in-class unit economics, driving 30% free cash flow margins. And given its role as the workflow automation engine for large enterprise IT departments, ServiceNow is definitely contributing to the tech intensity productivity story that Satya Nadella was talking about. And then lastly, Cloudflare. So we pitched this stock a year ago at $74 a share. It closed at $210 last night. I think it's down a bit today. But I want to try to bridge the gap between a year ago and now. So a year ago, you might recall, many work from home beneficiaries were still trading at peak multiples. So, Zoom, Peloton, Twilio, and Teladoc. Our focus coming into 2021 was identifying names that we thought could beat and raise through the year. And Cloudflare was one of those businesses that fit that description. A year ago, you might recall us discussing the transition from legacy castle and moat security architectures, which were very firewall centric, towards something called zero trust security. And we talked about Cloudflare's distributed edge network as being uniquely positioned to deliver zero trust security and compete with the likes of Zscaler. So sure enough, over the last 12 months, we've seen the core security business accelerate. It has sustained over 50% growth each of the last 5 quarters. The elevated threat activity that started at the beginning of the pandemic continues today. We've seen this year, President Biden has even made cybersecurity a national priority. And Biden has specifically called out zero trust architectures as the way forward. And Cloudflare was historically viewed as an SMB security solution, but its platform is now resonating with the biggest customers in the world, including a recent win a couple of quarters ago with the Department of Homeland Security. And a year ago, you might recall that we highlighted some optionality that was embedded within Cloudflare's serverless edge compute platform, which we viewed as potentially setting up Cloudflare to compete more directly with the major cloud service providers, being Amazon, Microsoft, and Google. We were especially impressed with Cloudflare's developer mindshare and their pace of innovation, which remains fierce even today. And we think the recent move in the stock from 110 to 210, which just over the past 45 days or so, was largely due to some new products announced around edge compute, and specifically a cloud storage solution named R2. And this officially positions Cloudflare as a legitimate alternative to the big 3 cloud service providers, with Cloudflare's value proposition, for now at least, being much lower cost as they slash egress fees. So I think the investment community has gained a new appreciation for this business, and the stock has re-rated substantially. And as the stock has re-rated, the thesis has really evolved. So this is now being viewed as more than just a security company. This is a private backbone that sits in front of the major cloud providers, and they are in a unique position to enable the next generation of cloud, where customers can more easily move between clouds and take advantage of the best each cloud has to offer. So we also think this serves as a good example of how we try to uncover underpriced optionality in a business. So now we want to touch on contributors and detractors for the year. And again, we'll use this as a launching point to talk about some industry trends. So in addition to Cloudflare, NVIDIA has been a top contributor for the year, up about 135% year to date. And I thought it might be helpful to look at NVIDIA and semiconductors more broadly from a 30,000-foot view, given how the industry has really been thrust into the limelight given supply chain constraints. So this image might look familiar from previous presentations we've given. This shows you how we think about the secular growth industries that we're investing in across our strategies. But one thing we've historically omitted from this graphic has been the foundation for all these technologies and a significant component of our portfolios. So we have revised this image to look like this. And you can see we've inserted into the bottom here the quite literally the foundation for all technology, which is semiconductors and the semiconductor industry. And like I said, the industry gained renewed appreciation over the past year. Semis have been central to the global supply chain constraints. And as a result, there seems to be more and more push for technological sovereignty across areas like China and Europe and the US. In a webinar a couple of years ago, we talked about this concept of Industry 4.0. We would loosely describe that as the convergence of technologies like cloud, Internet of Things, and 5G, driving a proliferation of connected devices an explosion of data, and enabling the automation of legacy industrial operations. Well, many of these trends, like automation, have accelerated because of COVID and are driving demand not just for more electronic and connected devices, but more silicon content per device. And you can see here, we are really in the early innings of what we consider to be the decade of data. And the explosion of data over the last few years has mostly been derived from the consumer internet, whether that be Google searches or likes on Facebook or products that you bought on Amazon. But moving forward, we expect the majority of data generated over the next decade to be generated by machines, whether that be airplane engines or ADAS sensors in your cars or surveillance cameras or factory robots. And automation, again, just to tie this into the inflation discussion, automation is a great example of how tech CapEx drives productivity growth. And this will be critical in how our economy absorbs the inflationary backdrop. And all of this has critical implications for semiconductors because silicon content and complexity is increasing across all devices. And this is driving the semiconductor industry from about $500 billion in revenue today to double over just the next 10 years to $1 trillion. This here is a similar chart showing semiconductor industry revenue reaching $1 trillion by the end of the decade, but the orange line here breaks out the wafer fab equipment industry in orange, which is expected to outpace the broader semi industry. And that's really primarily due to increasing complexity as fabs need to purchase more sophisticated equipment for things like new structures, like a 3D architecture, or new ways to shrink, like extreme ultraviolet lithography, EUV, or advanced packaging methods, things like chiplets. So that in a nutshell provides the sort of holistic backdrop for many of our semi investments. And we invest in the best positioned players across the entire value chain, from equipment like ASML and Applied Materials to pure play foundries like TSM, and then of course, fabless design companies like NVIDIA. So back to NVIDIA, and NVIDIA specifically, why do we continue to like it? So first, the stock has moved in anticipation of their annual developer conference, which kicked off today. There were a number of new product announcements already, but the theme of the conference seems to be around digital worlds, or what NVIDIA calls the omniverse. So whereas Facebook is talking about the metaverse from a social and commerce standpoint, NVIDIA is approaching it more from an industrial simulation standpoint. So think digital twins and simulation. And of course, this all has implications for productivity growth as well, which we already touched on. So NVIDIA has always had a very rich software stack, but it was generally not monetized directly. They were generally monetizing silicon. But now they will be selling software on a subscription basis. And in addition to the software strategy, they are still in the midst of a new product cycle with Ampere architecture. They have a new ARM-based CPU for data centers that will be launched in 2023. Then there's the potential acquisition of ARM, which we think is a low probability event and not priced into the stock. But if approved, we think the market would view that very favorably. And then lastly, we think auto is going to be a much bigger part of the story going forward. Right now, this is really a gaming and data center business, but NVIDIA has had substantial design wins in auto, and that's expected to drive an inflection in auto revenue over the next few years. So Amazon has been one of our biggest performance detractors for the year by nature of our overweight position combined with a sideways correction in an otherwise very strong market. So we put these slides together last week. The stock has acted a little bit better recently, but this is a bit of a mea culpa. Amazon has been one of our favorite ideas since earlier this year. I think it's worth reviewing the thesis because it touches on important trends like e-commerce, transportation, supply chain, labor markets, and even cloud and digital advertising. So our thesis a year ago was that even though Amazon's e-commerce business was facing very difficult comps, we thought the company's high margin revenue streams like cloud and advertising were poised to really accelerate and drive profit beats. And now those businesses did in fact accelerate in Q2, and AWS accelerated even further in Q3. However, those profits did not flow to the bottom line because, as we learned on the Q2 earnings call a few months ago, Amazon was beginning another investment cycle in order to catch up with elevated demand. You can see here, Amazon pulled forward 2022 investment into 2021, and they've just about doubled their fulfillment network over the last 2 years. And considering their scale, that's a pretty remarkable statement. And then compounding margin pressure in Q3 has been wage and transportation cost pressures. You can see here for Q4, management is expecting about $2 billion of labor inflation, $2 billion of operational disruption, and that's mostly transportation costs. According to management, only about half of wage increases are permanent in the form of base pay, the other half being sign-on bonuses, which are not permanent. And then, of course, we expect transportation cost pressure to ultimately be transitory. So admittedly, we were early in making a call on margins. However, this is not the first investment cycle we've been through with Amazon. Management has demonstrated the ability to thoughtfully invest in high ROI projects historically, and we continue to like the setup into 2022. So why do we still like the stock? We think Amazon has the resources and preparedness to potentially gain share this holiday season as other retailers struggle with inventory and transportation. In addition, Amazon is planning to ramp up one-day shipping, which was disrupted by COVID, but its first attempts at ramping up one-day shipping prior to COVID did show early indications of accelerating growth. And then cost pressures should abate by the second half of 2022. At the same time, e-commerce should be re-accelerating off of easy comps and driving operating leverage by growing into its new capacity footprint. So we'd expect the stock to start discounting some of these dynamics in early 2022 and in the not too distant future. And lastly, from a valuation perspective, we think the stock is meaningfully undervalued on a sum of the parts basis. So now we'll talk about a name we like for 2022, and that is ZoomInfo. So we think ZoomInfo is an example of an idiosyncratic idea with a rich catalyst path that we believe can outperform in any interest rate environment. So first, what is ZoomInfo? This is a software platform designed as a B2B solution for sales and marketing teams that utilizes AI and machine learning techniques to process billions of pieces of raw data in near real time to generate insights on 15 million companies globally. And ZoomInfo then provides these insights to sales reps and marketers to help them with both lead generation and customer engagement. Now, stepping back to the 30,000-foot view, we already talked about this being the decade of data. We think that data-driven decision-making is becoming table stakes for all organizations in every industry. We hear this from every company we follow. And when harnessed and applied thoughtfully, data is a really powerful asset that can drive new business and improve productivity. It's something that companies really can't afford to operate without. And as you can see from this graphic, only 1/3 of a typical sales rep's day is spent selling. And then gathering and entering data comprises another 1/3 of the day. So back to the topic of productivity, this is really the inefficiency ZoomInfo is trying to solve. So here I think remains one of the biggest misconceptions about the business. At IPO, it was fair to categorize ZoomInfo as just a contact database. Since the IPO, however, the company has been aggressively expanding into adjacent verticals. And it's really evolved into a much more strategic platform, a platform of action rather than just a contact database. And this includes things like customer engagement, email campaigns and the like, also online chat solutions, things like conversational AI. And as a platform, ZoomInfo will not only drive stronger fundamentals, things like higher revenue growth and higher retention, but a software platform also deserves a premium multiple to that of just a contact database. You might have heard us say this before, but we really like to invest in platforms with the ability to expand into adjacent verticals and cross-sell customers at very low marginal cost. And we think we're seeing this play out with ZoomInfo today. They're landing larger customers. Customers are purchasing more products in initial deals. And management said on the last call that the leading indicators suggest net dollar retention is poised to increase for these very reasons. So for a lot of these high growth businesses, there's typically little or no free cash flow to speak of. And that's not a bad thing in and of itself. It just requires us to dedicate a lot of time and energy digging into the unit economics of the business to try to model the path of operating leverage. Ultimately, model the path of operating leverage and ultimately terminal margins. But thanks to ZoomInfo's really unique profitability profile, we are spared the task of trying to figure out where free cash flow margins could potentially go 10 years down the road. Today, they are already demonstrating revenue growth of 60% at an $800 million run rate with unlevered free cash flow margins in the 50s. And in this chart here, we are showing something called the Rule of 40, which is a benchmark used in the software industry that adds revenue growth plus free cash flow margin. And you can see here that ZoomInfo stands amongst pretty elite company by this metric. And not only does ZoomInfo generate best-in-class unit economics, but we would argue this is one of the least penetrated markets that we've seen in enterprise software. And on-market penetration, we estimate ZoomInfo is about 2.5% penetrated in sales seats on a global basis. Not to mention all of the new products ZoomInfo is selling into its customer base, which is expanding its market. So a big part of our thesis here is that growth will be much more durable than consensus estimates. Here you can see revenue growth on the left axis represented by the blue line. And we think the company can sustain 28% revenue growth in 2025. And that's based on our assumption of customer growth and revenue per customer growth. But you can also see what this implies for sales efficiency, which you can see here on the right axis and illustrated in red. We think that can stay range bound within that 2 to 3 times range. And that is essentially showing that ZoomInfo should be able to drive this level of revenue growth by generating a similar level of ROI from their sales and marketing investment. And it's actually, importantly, it's not unprecedented at all for a subscription-based platform like this to sustain high growth for many years. The high growth, high margin platform characteristics of ZoomInfo, it somewhat reminds us of ServiceNow and Viva in their very early years. And today, those companies are still growing 30% top line at much larger scale. So where can ZoomInfo trade in a few years? Using a peer group regression consisting of cash generative software peers that we can benchmark against, we think ZoomInfo should trade at about 58 times free cash flow in 2025. And that's based on our forecast for 28% revenue growth at that point in time. And you can see if we were to extend this trend line, that 58 times multiple would actually be a slight discount on a growth adjusted basis to the peer group. And here you can see how that free cash flow multiple of 58 equates to a fair value of about $160 in December of 24. And that implies an IRR of about 30%. And when the market underappreciates growth, you really get 2 drivers of the upside. You get a market disconnect, not just the amount of free cash flow being thrown off in 4 years, but the higher growth rate also commands a higher multiple being applied to that higher free cash flow. And here's sort of the catalyst path that we see over the next 12 months. We expect very strong Q4 results when the company reports in late January, early February. Since IPO, they've beat guidance by about 7% at the midpoint. More important, however, the company will issue 2022 guidance on that call, and consensus estimates in our view are very low at 33% growth next year, down from 57% growth this year. So we think the guidance is going to be a positive upside surprise. Secondly, the company recently eliminated its multi-class share structure, and this makes the stock eligible for inclusion in the stock indices, such as the S&P 500. And we think this is potentially a late 2022 event. And then lastly, this is something we look for in all of our businesses, but we expect a consistent cadence of product announcements to continue, and that will expand the addressable market. So with that, I can turn to questions. And I guess before I do that, just my final remark would be whatever views you have on the macroeconomy, the fundamental backdrop for growth and tech stocks remains very compelling. And when you think about things like 5G, IoT, cloud infrastructure, cloud applications, cloud security, electric and autonomous vehicles, we're still in the very early innings. And these are really stories that will last through the next decade. And then meanwhile, the pricing power and cost structure of our companies positions them very well for inflation. And technology may very well be one of the beneficiaries and solutions to the inflationary period. So with that, I'm going to stop sharing my screen and try to pull up questions. So please bear with me while I do that. Hopefully you all can still see me and hear me. Okay, so here's a question. Hold on one second. Okay, I have a question that came in through email and some through the chat box. So the first question, an email, address the topic of the present deluge of IPOs and SPACs. How in the world can you keep up with this torrent and do your research? I guess you must be throwing out most of them at first sight. It certainly is mindful of the 1999-2000 period when we saw that huge collapse. So on IPOs and SPACs, I think, so you're right. We don't look at every new listing. We do read an alarming number of S1s and attend a lot of IPO roadshows. And that helps us keep our finger on the pulse of new entrants. But we're really focused on a handful of secular growth industries. And this sort of speaks to our general investment process as well. But within each industry, we really seek to map out and understand the competitive landscape and the value chain in as much detail as possible. And as a result, we have a pretty good feel for the competitive landscape on both the public and private market side as well. So we usually get familiar with these businesses well before they file for an IPO. So Snowflake is a good example. We've been following that business for many years because Snowflake competes with the cloud service providers that we own, who also offer alternative solutions for cloud data warehouse. And today, just to stretch the example even further, we've been shareholders for Snowflake since the IPO. And as a result of our research process there, we've become quite familiar with another private company in the cloud data lakehouse data analytics space called Databricks, which is also a private company, I think valued at $30 or $40 billion. And Databricks is expected to IPO shortly. And that's one we'll definitely be prepared for. So point being, by the time a company files an S1, we usually have a pretty good handle on which ones we need to dedicate a lot of focus to. And then the second part of that question is about, I think, intimated that IPO activity is reminiscent of 1999. I think it's fair to say there are pockets of bubbles in corners of the market. The one thing to keep in mind is that the 10-year yield today is 1.5% or 1.4%. 20 years ago, it was 5% or more. So obviously, we have a very different interest rate regime today, which supports higher multiples. And then also, the quality of businesses today are much higher. And the one statistic I can point to justify that is the price to free cash flow multiple of the tech sector today is a little over 30 times compared to early 2000 when price to free cash flow was over 100 times. So these companies today are generating cash. And I can't justify every high multiple stock in the market, but what I can say for the software stocks we own, at least, I think there's enough precedent at this point that the more mature companies in the space have proven these business models to be very durable and profitable. So even a company that might not be generating cash today because they are investing aggressively in growth, as long as the unit economics are stellar, it's still something we'll take a close look at for sure. And that's one of the reasons we emphasize unit economics a lot in our work. Let me see. Question in the chat box: how constraining is the current chip shortage in possibly retarding your expected decade of data? Where is the light at the end of the chip shortage? So this, if you have there's no straight answer. Every company has a slightly different timeline for when things will start to normalize, but I think it's safe to say the shortage is going to extend well into 2022. That being said, how that pertains to the cycle, and really we focus on semi cycles by end market. Right now, we're a little more, have a little more preference towards things like data center and 5G relative to things like handsets, for example. But I think generally speaking, the cycle will be extended, and some are calling it stronger for longer. I think that's a pretty fair thing to say. And as of inventory in the channel, there's no obvious signs of a big inventory buildup anywhere or double ordering. Their auto chips are shipping well ahead of auto production. That's a slight concern, something we're watching carefully. But again, you have to consider the silicon content per vehicle is going up so dramatically that explains a lot of that. Let's see. When do you sell Cloudflare and how do you justify the multiple? So we actively manage that position size because we don't want that to represent too much of the portfolio at these levels. However, the catalyst we outlined a year ago, let me put it like this. Events seem to be playing out faster than we had anticipated, and that might continue. The business has a lot of momentum, especially moving up market to large enterprise, and we think that can drive sustained revenue growth in the 40 to 50% range for years to come, and that's well above street estimates. And this is still a founder-led company, a truly visionary CEO, and the dedication to innovation and a cadence of new products is just astounding. To justify the valuation at these levels, I don't think you can buy the stock with your thesis being that this is just another best of breed zero trust security player. I think at these levels, you need to believe that Cloudflare is going to take some share in the public cloud domain. So the way we think about it is the global IT addressable market is about $2 trillion. The infrastructure as a service and platform as a service addresses about half of that, so call it $1 trillion. And this includes all on-premise IT assets that are yet to move to the cloud. So even if Cloudflare can capture just a few points of that market, and then you apply a 15 times, 20 times revenue multiple on that, that's an enterprise value in the hundreds of billions. Admittedly, the challenge is identifying the time frame. So is that 10 years from now or 20 years from now? And that's what's ultimately going to determine the IRR. But we run some scenario analysis around things like that, market share and various time periods, and we think there's still just enough upside potential here to hold the stock. Taking advantage. Another question here that I can't quite understand, so I'm going to skip that one. We have, what is your Facebook thesis and view on the name change? So I think what is your Facebook thesis and view on the name change? So I think the big picture reason for the Facebook strategy pivot, Zuckerberg is determined to control Facebook's destiny by influencing the next platform shift. Unlike the shift from desktop to mobile, when Facebook found itself completely dependent on Apple's iOS and Google's Android. And I think recent events around Apple's iOS changes, which made it harder for apps like Facebook to target ads and measure conversion. Facebook's vulnerability to the operating systems has really never been more clear. So they're already taking steps to rebuild their tech stack for targeting with less data, and they're building out commerce products so they can measure conversion on platform. But as long as mobile operating systems are the primary domain for apps like Facebook, they're always going to be subject to the whims of the operating systems. And so for this reason, Zuckerberg wants to influence the next platform shift. And in his mind, he's been saying this for years, the next platform shift is going to be virtual reality. And this explains Facebook's investment in Oculus. More recently, the term metaverse has become almost cliche in the world of tech to describe an online world where people interact through avatars and the like. And Facebook has really embraced this metaverse vision and is marrying it to its hardware and software platform for virtual reality. So don't be mistaken, this is not going to contribute to revenue for many years, but I do think Facebook has a unique set of assets that position it well for this, including not just its lead in virtual reality, but a 3 billion person social network, tools for commerce and advertising, and they're building out more tools for the creator economy. So look, you're paying 20 times 22 earnings for a business whose core ad platform does remain strong despite some transitory headwinds, and they have interesting optionality as they expand into social commerce, and then longer term, the metaverse. So let's see, I'll take one more here. There are a couple here that I don't quite understand. How will inflation impact growth stocks? What is your expectation for inflation? So how will inflation impact growth stocks? First, let's consider that in two parts. So inflation has an impact on interest rates, and rates have implications for the multiple you pay on stocks. And then separately, inflation has an impact on fundamentals from an input cost perspective. So those are two separate issues we'll talk about. On interest rates, growth stocks are considered long duration assets. And this is something we've talked about in the past, in fact, probably on this webinar maybe. But think of long duration stocks as a growth stock that has a significant portion of its net present value residing in expected cash flows way into the future. And these are stocks that some might refer to as statistically expensive because they trade at very high multiples. So as discount rates rise, all else equal, the value of those cash flows will be worth less. And so those stocks will have their multiples contract. However, from a fundamental perspective, the businesses we own have some of the best pricing power and lowest marginal costs that you'll find anywhere. So it's really hard for us to find a risk to cash flows of our businesses, even if inflation persists. And furthermore, even if inflation persists through 22 and rates do tick up and the economy is poised to slow, as we discussed, PMIs are poised to decline, that's generally a very supportive backdrop for growth stocks. As growth becomes more scarce in a slowing growth economy, companies that can generate organic growth are in higher demand. And what's interesting is over the course of recent history, when PMIs and interest rates have diverged, performance of growth stocks has a pretty mixed track record in that environment. So that's why even if you think rates will rise in 22, it's really not clear that will be a headwind to growth stocks. And I guess our expectation, so then the second part of the question is expectation for inflation. I think that kind of answers it actually. So we think it's just way too hard right now to predict with any precision what will happen with the inflationary backdrop. And so if PMIs decline and inflation persists and drive rates higher, those are really two dueling forces on growth stocks. And that's why today we're positioned really quite intentionally to not be making a bet on the inflation backdrop. We're trying to identify idiosyncratic ideas that can outperform in any environment. So I think that's it on the questions. I apologize for those who I didn't answer. You can feel free to email me directly at cward@gabelli.com to clarify your question. We can definitely talk online. But other than that, I really appreciate everyone for joining, and have a great holiday season if you don't hear from us again for the next couple of months. Thanks.
Investors should carefully consider the investment objectives, risk, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.